This week on the podcast, it's Quickfire Finance with Claire. Yes, how many terms does she know? Welcome to the Profit Cash Growth Podcast. This is the podcast for 6 and 7 figure business owners who are looking to grow a financially successful business. My co-host, Claire Hancott, is a finance director, chartered accountant and entrepreneur. And every week, I'll be exploring guidance and frameworks designed to help you increase your profits, improve your cash flow and grow your business. Right, third time lucky. Are we going to get this time?
I think we are. We're ready now. No coughing, no stumbling on our words. Let's go.
We had loads of good stuff to talk about. We're not going to talk about the world's longest nap yesterday. What's the world's longest nap yesterday? What happened? Well, we nearly missed dinner because
we got into bed at 4 o'clock in the afternoon, didn't we? And we didn't wake up till 6:30, and we nearly missed our dinner reservation.
But luckily, the restaurant rang and pushed it back for a better table anyway.
Well, that was what woke us up, wasn't it? When they rang just to ask if we could come a bit later. So
much small to talk about because we've just found out as well that furniture. I've been wasting so much money on like glasses cleaner to clean my glasses. It turns out furniture polish is just phenomenal.
The best thing ever. Look,
I've never seen so well. In fact, who are you?
Simon, this is not the intro of one of the most popular business podcasts in the UK.
No, it's not. And last week's episode, people absolutely love last week's episode about Amazon. It was our number 1 most downloaded first day episode that we've ever had. So thank you very much for that. I'm pleased you really enjoyed that. Anyway.
Can I just also add what else other people are loving this week? I put a post on LinkedIn. If you haven't seen it, go and check out my LinkedIn page. I think it was like Wednesday the 10th. Don't think it was the 10th of October, but around the 10th of October, go and check out my post. There is 20 tax hacks, I called it, that limited company directors should know about. So all the types of costs and things like that you can put through your company. And yeah, people seem to be absolutely loving that on LinkedIn. Quite a few tips and tricks. So we will do a podcast in that in the coming weeks and talk about a couple of the more unusual ones that are actually really quite generous.
Yeah, that would make a good episode, actually. Well, back on script, you said you wanted to hold this for the podcast. We want to talk today about one of the world's best business people, Taylor Swift.
That's quite a statement, best business people.
Well, I think she is probably one of the world's best business people.
Yeah, she is actually. When you hear her talk, she's very switched on,
isn't she? She's a multi-billionaire. I mean, she's come from nothing.
Now, her album came out this week, and I was astonished to hear that all of these businesses, like hotels and cinemas and cafes and things, were doing like listen parties where people would, there was like a hotel quite local to us and they put on a Taylor Swift listen party. So you go at like midnight and you sit around all these women wearing cowboy hats, pink fluffy cowboy hats and cowboy boots and stuff. And it was all women, and have afternoon tea at like midnight and listen to her album as soon as it comes out. And yeah, that apparently is a thing now. And it just baffled me. It really made me realise that you can literally make money doing anything. But you said that I
was partly delighted that the excitement around music and new albums is still there, because I felt it had died since the 90s. And I was telling you about when Oasis's third album came out, which I've got my for listeners, I'm pulling up. I went through the shed and I found the original version that I bought, 1997. So if you just open, this is Be Here Now by Oasis. So it's the third album they released. Let me just tell you a story just to set the sort of background of this. So Oasis had 2 of the world's best albums ever. And then they had this reasonable sized gap. And everyone was waiting for this third album with such trepidation. So when they launched the first single on the radio, it was, do you know what I mean? I was 12 at the time, and I remember running to my dad's hi-fi stereo, which at the time took up a whole corner of the room, because that's how big they were. They were separate. And I would stand there when it came out on the top 40, the first play of it, with such excitement. I was on my knees on the floor with both fingers on the play and the record button of the cassette to record it at exactly the point where the DJ stopped talking. So that's what you used to do. You used to wait till the talk 40. Over the intro, and then you'd press play and you'd record it, and then and you'd listen to it over and over and over again. So that was the single. And then when the album came out, it was the build up to it was so big. If you open the case there, Clay, you'll see on the inside it will give you it was so big. The inside gives you the date of the release, which is what?
Thursday, August 21st.
Thursday, August 21st. And there was such a commotion about it that people queued at midnight in record shops. And if you pull out the thing there and you look at the little embossed stamp on the front and read out what it says, on the front page is a little embossed stamp.
Oh, yeah. It says, I can't quite read it. It says first day of issue. Ainsley's first.
So Ainsley's record shop.
You went and got this embossed.
So part of the deal was if you queued up, the first 100 that they gave away or whatever else got theirs embossed with a first day of release stamp.
And what's Ainsley's? Is that like your local music shop? So it's not even anything to do with Oasis?
No. It's the record store, but they sort of stamped it. And
do you know
that's how wild it was. And do you know the irony of it? It ended up being a terrible album.
But not to you. Do you know what I find most interesting when you look at this is, so I've got the album sleeve out, and on the back of it, to be added to the mailing list, you have to write to them, and they've got their address that you have to write to.
Yeah.
And I just think it's really quite nostalgic, isn't it? The fact that people would actually
It also made me realise, like, that's 1997. I'm thinking, wow, I had to just try and work out how and why I, as a 12-year-old, went into town at midnight to go and stand at a record store. I'm just thinking
Did your parents let you do that?
How many parents would let a 12-year-old?
But I guess there would have been so many adults in the queue.
Yeah, I don't know.
Anyway, that was a little walk down memory lane.
There you go.
It's still living.
So pleased that the music industry has got that excitement about releases and albums, because I'm a big music person. I love it. So
yeah, and I am really glad that one of the 5 boxes of CDs that have been in our shed and stored in our loft, etc., ever for 15 years now, has actually had some use finally for just one of them. Thank goodness that we've kept them all, hey?
Great. Right. Shall we move on to this week's news story of the week, Claire?
Let's do it.
So this week, the headline that I picked up was record number of UK companies paid most of their invoices late.
This was a story in the Times, wasn't it?
Yeah, this is a survey of 5,000 businesses. It's regularly done by an organisation. They found that more than £1 billion worth of invoices were not paid on time in the first 9 months of this year.
Well, this is taken from the government information that large businesses have to publish called payment practice reporting. And there's, I think, maybe like 7 or 8 questions that you have to answer about how many invoices you pay within like 30 days, 60 days, on time, etc. And I used to do this in the last organisation that I worked at in the corporate world. And even then you could not skew the numbers. I don't think that's the right thing to say, but there wasn't an official, the definitions could be interpreted, let's say. So you have to take this information with a pinch of salt, but it is on the public register. You can go and see how any of the big companies that have to do it generally is for the really large organisations. You can go see how anybody, Tesco's, Morrison's, Jaguar, all of those people, what their payment practices are like, how they deal with disputes with suppliers, how frequently they pay them. Anyway, I think you have to take this with a little bit of a pinch of salt because firstly, it's large organisations only. So generally it's like greater than 250 employees. They'll be really, really big companies. So large organisations only. And I think it's this definition of what is late.
Yeah.
Because we encourage people to do a payment run at the end of every month plus normally 5 days. And there are lots of practical reasons why we suggest that you do plus 5 days. And mostly it's because like it just gives you time to process all the invoices and you make sure that you gather everything. You're only doing one payment run and you're not missing anything. But technically you're paying all those invoices late.
Yeah. So in this report, so would you say the average company took 80 days to pay? So is that long? Little sneezy there.
Oh, sorry, excuse me. 80 days. I mean, it sounds like a long time, doesn't it? I think anything more than 30 days in a month is a long time.
Months, yeah, and that's the average. So it is quite long. So this isn't probably just strategic late paying. They're pushing their cash flow, aren't they? Is this a sign that cash flow's more challenging now?
I don't think these numbers have specifically changed much. We've always had this, and obviously it's something that Labour government have been talking about cracking down on, is forcing these larger organisations to pay particularly small businesses quicker. But this has been around for years and years, and I think payment practice reporting was introduced I think about 10 years ago now, and it's done nothing. It's had no impact on how people pay, even though this information is in the public domain. Nobody really looks at it, nobody cares about it. So yeah.
But the story is specifically about they obviously track this all the time. So the story is about that this is getting longer, not that it's always been long. So is there a view as to why it's actually moved and got even longer?
Well, yeah, because I think a lot of it is in big organisations. They'll be a lot more attuned to their cost, what's called your cost of working capital.
Yeah.
So this was something that we used to track, and it basically is It essentially tries to apply an interest rate to the amount of working capital that we hold, i.e. the amount of cash and debtors and things like that we've got on our balance sheet. And it kind of applies essentially an interest rate. And you can look at that two ways. That's either the interest rate that you're paying if you've got debt, or it's the interest that you would be losing if you don't have that money available to put into an interest earning account, for example. So large businesses will be really tuned into average working capital costs, and therefore they will be looking at what's happened with interest rates and the fact that interest rates have gone up so much and said, why don't we take advantage of the free credit that we get from our suppliers and not pay for third-party finance where we're being charged interest on it?
Yeah, good. Well, interesting. And like you say, it does all link back to the changes the government are trying to do around this whole naming and shaming of companies and various other things. So it does feel like it's been a little bit planted by the broader things that are going on. But
they've done it for 10 years now, and it's not changed the payment habits of any organisation.
Well, they've got longer. That's the story.
Yeah, so actually it's making it worse.
It's
well
just
done.
getting worse.
Yeah.
It's just always been bad, but it's actually getting worse. So great. Well, let's move on to this week's deep dive. So this week, Claire, Quickfire Finance. How many terms do you know? I'm hoping you know them all. What do you think?
I'm going to know them all.
You're
this
gonna
is
nail
like
it.
classic textbook stuff.
So the reason that I've done this is that I saw a LinkedIn post recently that basically just listed out, like, here's a whole list of KPIs that you need to be aware of or know. Most of them I knew, some of them I didn't. And I just thought what we'd do, there's about 20 of them, we're going to fire through them one at a time. I'm going to test you on them, Claire. I'm just going to ask you whether you can, give me some context about what it means. So breaking the jargon into plain English, what does it mean? What does it mean to me as a business owner, and how should I use it? And if I do use it, how do I use it to benefit me and my business? Does that make sense?
Yep, absolutely. And there's actually 15, not 20.
Oh, is it? Okay, not as many as that. I wish we had like the countdown music in the background. Gross profit margin. Go on. We're starting with gross profit margin. So everyone should know this. Please tell me you know this, but go.
Gross profit margin is going to be your sales less cost of sales.
Yeah.
And then you're going to divide that number by your sales. So it's going to give you a percentage. So it's going to tell you that for every £1 of sales you make, hopefully you're going to be making like 60-70% gross profit margin. So after your sales and you paid for all of your direct costs, like materials, delivery, things like that, what are you left with? It doesn't include any of your overheads.
Perfect. My next one is net profit margin.
So that's going to be at the bottom of your profit and loss, and that's going to be your gross margin less all of your overhead costs, or what we would call fixed costs.
Okay.
And those two are key numbers. Well, definitely net profit margin. Every single business should know net profit margin, but gross profit margin, I would say, take with a pinch of salt if you're in some sort of service industry. That really, a gross profit margin really is more relevant in stock businesses, manufacturing businesses, that type of thing, when there's a cost of delivery beyond people.
Okay.
If you're a service organisation, gross profit doesn't really apply.
No, I guess I'm thinking like in mine and yours, it's just so high, it's not that relevant, is it? Because all your costs come in like below the GP, so to speak.
Yeah, I mean, we do fancy things with our gross profit margin.
So
like,
we try and down into it.
Yeah, we try and make sure that we don't want to put somebody's salary in there, because if you've got somebody on 40k salary, your gross margin is always going to be really low until you've covered their salary.
Yeah.
So having a fixed cost in your cost of sales really does skew it. Whereas what we would try and do is allocate like worked hours or billable hours, that type of thing.
Yeah.
And there's lots of different ways to do it. But yeah, if you're a service industry, I'd say steer clear of gross margin probably.
When you say billable hours, is that typically is that why the legal world does this like billable hours thing? Because they do try and like literally apply like the hourly rate of their person to like the revenue.
Yes. Hourly rate or a daily rate. Yeah.
Okay. Interesting. Next one was operating margin.
Yeah, so this generally refers to EBIT or sometimes EBITDA. So it's earnings before interest, tax, depreciation. And people often confuse this with profit. They'll say, oh, my EBITDA is really good. And it's like, okay, but after your depreciation and your interest costs, etc., what you're actually left with. So I'd say net profit margin is more important. However, if you get in finance, if you've got external investors, then EBITDA can be quite useful. And one of the reasons that we would typically say use EBIT or EBITDA is if you've got different businesses and you're comparing across different businesses, it's a metric that removes any of the nuances about whether they've got interest because they've got loans and things like that. All of these things that can vary greatly in different businesses. It kind of allows you to strip all of that out and say, on a day-to-day basis, how profitable is this business?
Gives you this real like operating run rate type thing. Is that what you mean?
Yeah.
Okay, so I think we've done the easy ones because they get more difficult now.
Yeah, absolutely.
So the next one I've got is current ratio.
Okay, so current ratio is all around your liquidity and how basically you take everything that's owed to you, all your current assets, so everything that you own or is owed to you. So that would be your stock, your cash, and your debtors, so money owed from customers.
Yeah.
And you divide that by everything that you've got to pay in the next 12 months, so your current liabilities. And generally, if it's less than 1, it means that you owe more than you own.
Okay.
So you've got a problem. Less than 1 means you've probably got a liquidity problem.
Yeah.
And greater than 2 means that you're in quite good shape. So I always take this with a pinch of salt, because if you think about that calculation that we've just done there, the assets that we're generally putting into that would be your debtors, your stock, and your cash. Now, you could have a business that's sitting on a humongous debtors number or a humongous stock balance.
Yeah.
Because they're actually really poorly managed. And that stock balance can just keep going up and up and up. And they're not actually converting that into cash. So for that reason, take it with a pinch of salt, especially if you're not particularly good at managing your debtors or your stock, or you struggle with those areas, because you can have really high assets and actually those assets are never going to turn into cash. And
is this a metric you use much, and is it very
No,
useful?
we don't really use it because of those nuances around debtors and stock. It's much more applicable in large organisations, and if you get an external lending, they'll be looking at current ratio. Okay. The other area where it's quite common is like business credit checks.
Yep.
It would be because it's somebody can calculate it from the publicly available accounts that you publish, because people only publish their balance sheet, most micro businesses.
Yeah.
So it's one of the few ratios that you can calculate from your statutory accounts that are filed on Companies House. So therefore it appears on a lot of credit checks.
Okay.
So it's something to be aware of. I wouldn't say it's about the performance of your internal business, but it's about managing external stakeholders. If you want investment, if you want trade credit, if you want finance.
It's giving them a real quick comparable thing they can compare across different businesses give them a great. Next one I know is quick ration.
Quick ratio.
Oh, ratio.
Okay, so
quick got an N there.
Quick ratio is exactly the same as your current ratio, except we don't include stock. So it's your cash plus your trade debtors divided by everything that you owe in the next 12 months.
Okay.
So all the same sort of limitations as current ratio and how it could be used need to sort of apply to that.
Okay. Debt to equity is my next one.
Okay, so your debt to equity, this is your total debt that you've got in the business, any loans that you've got, divided by your equity. Now, again, take this with a pinch of...
How do you work out your equity unless you have your business valued?
So your equity would be at the very bottom of your balance sheet. Okay. It would be share capital.
Yeah.
Which for most small businesses would either be £1 or 100. Generally, it's the amount of ordinary shares that you've got in your business is a very general rule. And most people, when they set up their limited company, will go with 1 or 100. Right. And so that would be your equity plus any retained earnings. So profits that you've got in your business that you haven't taken yet as dividends.
Yeah. Okay.
Now, for small businesses, you've got to take this with a pinch of salt, because a lot of business owners will be taking pretty much a lot of the retained earnings out every year in dividends, which is totally fine. You know, that's why they're running a business. And so this applies a lot more in larger organisations that maybe wouldn't be paying out all of the profits and dividends every year.
So when they refer to equity, they're not remotely talking about the value of your business. They're talking about the retained earnings in your business that have already been made.
Yeah.
Yeah.
So it doesn't really have that much of a place in small businesses, because how often you pay out dividends can massively impact that number. But generally, the lower the better.
Nice.
Is how that's seen.
My next one is inventory turnover.
Yes. So this is going to be... Essentially, this is trying to tell you how many times you turn your stock. So in a 12-month period, for example, how many times essentially all of your stock sells and you replenish it.
Yeah.
Now, a good number completely depends on the industry you're in, because think about a supermarket that's got a lot of fresh goods. They're going to be looking to turn their stock every few days.
Yeah.
Really. But then, you know, a bigger business like cars, for example, they're not going to be looking to turn the whole stock of cars every couple of days, are they? Like a car company.
Business in houses, we'd look to turn our stock, maybe a good ratio would be 3 times a year.
Yes, absolutely. So not strictly, because you don't actually own the houses, but if you're a house builder, for example.
Yeah.
So there's no one sort of size fits all in terms of what a good number looks like. But to calculate this, you take your cost of goods sold, divide it by your average stock.
Okay.
And just make sure that, so generally I would say do that over a 12-month period. So take your cost of goods sold for a 12-month period, take the average stock that you held in that 12-month period, divide them by each other, and that gives you the number of times that you turn your stock. So if your stock is 300k and your cost of goods is 1 million, you're roughly turning it 3 times a year.
Excellent. Good. Next one I've not heard before is days sales outstanding.
Yes, so this refers to your trade debtors, so money owed to you by your customers, and it's going to tell you the average number of days it takes a customer to pay you.
Okay, that's simple.
Yep.
I get it.
So obviously a big number is not good. You know, as we were just talking about at the start with the news story, it's taking like an average of 80 days.
So
80 days is taking you to take cash in from that point of invoicing.
It's actually a massively
to getting paid.
Important number as a business owner to be tracking constantly, I would say, because you just want to be pushing that in the right direction on a constant basis, because cash is everything.
Yeah,
cash
absolutely.
is your lifeblood.
And it's not on here, but the other number that we then track is payables days outstanding. And obviously you want your sales number to be lower than your payables. So you're getting your cash in from your customers slightly quicker than you're paying it out to your suppliers. If you've got them the wrong way around, you've got a cash flow issue in your business.
Got it.
That you've got to plug.
Perfect. The next one is return on equity.
Yes. So again, limited use in small businesses because of the way that dividends are usually paid. Obviously, we know what equity is now. It's your share capital plus any earnings that you haven't yet paid as dividends. Okay. So basically, this is going to try and tell us for all of the equity that your business has got, how much profit we make. Okay. Yeah. So you're going to take your net profit, divide it by your equity. And
your equity being what we described earlier, which is retained earnings, dividends not taken.
Yes.
And various other things.
Yeah.
So because I use return on equity in property. It's like value your property portfolio and then work out the rent against the current equity that's in there, and that would give me a return on equity. It's like a return on cash.
Yes.
Return on
Now, where this becomes really important is when you're looking at making an equity investment. So you're getting a shareholder in your business. So think of like Dragon's Den, for example, where you're giving shares away. That return on the equity is going to be really important. How much profit am I going to make for every pound of equity that I put into your business? That's what that's essentially telling you.
Excellent. Next one is return on assets.
Yeah, so exactly the same sort of calculation as we just done with return on equity. It's going to be your profit, but instead of dividing it by equity, we're going to divide it by the total assets in your business.
Yeah, so that could be anything from buildings, trucks, whatever it is, whatever your assets are.
Yeah, but also cash. You know, the cash that you're holding. This is. You know, actually, I do think that this is often more about operational. So all of those assets that you've got is cash tied up in assets, be it cash sitting in a bank account just waiting to be spent, be it your trade debtors where you're offering credit, where you're offering terms to your customers, or be it physical assets that you bought and owned. You've tied money up. Yeah. So if you're going to tie money up, how much are you going to earn in return for every pound that you've tied up?
Isn't it interesting that we would calculate the return on assets, but we wouldn't class one of the biggest assets in the business as the business owner?
Yeah, I mean, absolutely. One of the biggest assets in the business is a business owner, but at the same time, that's just a person that theoretically should be replaceable. So,
but ironically, as we know, they're probably the biggest asset. They're the fundamental reason in most cases the business, grew in the first place and gets to where it gets to. We know it is. Like, took you out of your business, you wouldn't have a business.
You're going down a rabbit hole here. But
turnover rate.
Okay, so now, depending on what websites you're going to look at, you'll get a different definition for this. But certainly in the world that I come from, and my interpretation of it has always been related to employees, it's the churn of your employees. So how many employees leave in a year divided by your total employees. Okay. So if 3 employees leave and you've got 100, you've got a 3% churn rate on your employees. Turnover rate, yeah, or churn rate for your employees. So obviously...
That's a different one. Don't confuse it.
Well, use
got that metric coming up.
So yeah.
You're going to confuse the world.
But yeah, so for me, turnover rate has always referred to employees.
Revenue growth rate.
This is year on year, how much your turnover has increased by.
It's literally, what is it? Why has it got a fancy name that I've not heard of before? It seems just like sales growth.
Yes, sales growth. Yeah, that's the basic way of saying it.
Revenue growth rate.
So you're going to
we love to give everything a fancy name, don't we, if you have to?
And you're going to take the difference in this year's sales less last year's sales, divide it by last year's sales.
Okay.
It's going to tell you how much you've increased year on year.
Cool. And now we do have churn rate.
Churn rate. So this is your customer retention. How many customers did you lose last year? So you're going to take the amount of customers you lost, divide it by the total amount of customers.
Yeah. Customer acquisition cost.
So this is the amount of money that it costs you to win a customer. So generally this is going to be your marketing costs divided by the number of new customers that you acquired.
Yeah.
And be careful with this one, because a lot of people say, oh, we don't do any paid ads, so we don't really have marketing costs. But you really need to be looking at the marketing costs as in your time that you put into marketing as well. Try and put a value against that, because, like, for example, a lot of my day is spent on LinkedIn and doing sales calls and things like that. Yeah. So a portion of my salary should be allocated to marketing costs. Yeah. So you've got to be careful that you don't just take marketing costs on your P&L, that you're thinking about the true cost of marketing to your business.
Lots of people have a PA and they're doing lots of social postings and various things, so that's part of the cost as well.
And this is a really important metric to know, how much it costs you to win a customer, because this in particular, if you've got lower value products, this really gives you quite a stark realization when you think about the gross profit that you make on a sale. People often think, they get tied up, and this is I'm going down a little bit of a rabbit hole here, but bear with me. If you think about Google ads, for example, and any sort of paid ads that you do, they give you a return on ad spend.
Yeah.
They'll say for every £10 that you spend on ads, you get a sale worth £100.
Yeah.
Okay. But what if your gross margin is only £15?
Yeah.
Then actually you've made £15.
Yeah.
And so if your customer acquisition cost is higher than the gross profit that you make on that sale, you've actually lost money.
Yeah.
And that's where customer retention becomes incredibly important, because you've got to get that repeat spend. Otherwise you're in negative. So
this is where, like in lots of industries, so I'm just thinking of an industry that I'm heavily involved in at the moment, the kind of software industry, they look at this massively in terms of this links so importantly with churn rate.
Yes.
Because the two are completely interlinked. Because if you take the customer and you spend, but that customer acquisition cost pays back over a 12-month period, but you lose the customer after 3, you've got a real problem.
Yeah.
And actually your business is going in the wrong direction completely. It's a real problem.
Yeah.
So things like putting a number of these metrics together to create, a holistic, KPI dashboard is really important often, depending on the business. So yeah, I get that. Excellent. And the final one, which I'd never heard of, was CLV until you went, it's customer lifetime value. I'm like, oh yeah, I do know that one.
Yeah. So customer lifetime value, this is how much revenue a customer generates for you over their lifetime. Now, traditionally, this is actually done on revenue, but I prefer to look at this as gross profit for the reasons that we just spoke about, that it's very difficult to make decisions if we just keep looking at revenue and not gross profit. So I personally would always do this customer lifetime gross profit value, not sales value, because then you compare this to the customer acquisition cost.
Yeah.
And as long as your customer lifetime value is higher than your acquisition cost, generally you're in safe territories. But if you do this and your average customer lifetime value is lower than your acquisition cost, you've got a significant problem.
It's so important, isn't it? Because, if you acquire customers but they lose you money, you're just all you're doing is you're acquiring a loss every time.
Yes.
It's insane. And there are businesses out there that do this, that don't know their numbers and are like, going out and spend a load of money on marketing, acquiring loss-making business.
Yeah.
It's just, so you really do need to put the whole thing together.
And so to calculate your customer lifetime value, you're going to take your average order value multiplied by the average time a customer purchases from you, multiplied by the average lifetime.
Great. Well done, Claire.
Did I pass?
That's it. Boom. What have we learned today?
Well, it turns out I didn't learn anything.
No, but we, the collective, the listeners, our audience, our lovely people.
What did you learn?
You never learn anything because you know it all.
Well, this is what I studied, though.
Do you prefer the word genius?
I do like the word genius, but I mean, let's not get too big-headed.
So, yes, from this smorgasbord of pick and mix references, what are we taking from today? That you can use these in different ways, but you need to mix them together in the right recipe.
One thing that applies to most of our audience when you're sort of 7-8 figure businesses are approaching that is you need to shift that. You've got all these operational metrics, like your gross profit, your customer lifetime value, all of these internal things that mean that your business on a operational basis keeps going in a profitable way.
Yeah.
But you do need to start thinking bigger picture about where your business is going longer term, maybe getting equity investment, maybe selling, maybe getting finance. And that's where some of these more, what I would say, corporate ratios come in, like quick ratio and current ratio and return on equity, return on assets, all of those types of things are maybe not so useful as a day-to-day thing. But if you want external finance, the bank is absolutely looking at those ratios.
Yeah. or investment, or sale of the property, the sale of the business. There's three things, isn't there? Investment, an investor, or exit your business. Like getting this working like a well-oiled machine is going to be so important to getting the maximum value out of all of those different metrics. Yeah,
and that's why I wouldn't ever recommend just applying for a loan and waiting and hoping that it gets approved. You can really start proactively managing these numbers up front and making some. We can do a lot in terms of your accounts and some decisions we're making, just little decisions about whether we rent something or buy something, new equipment, things like that can have quite a significant difference on these ratios, which therefore can drastically change what happens from your external stakeholder perspective. So I would say that it's very important to have your internal dashboards that you're managing your business on an operational perspective. But as you start to grow, you do need to get a bit more savvy and tuned into some of these external stakeholder KPIs.
Great. Awesome. Thanks, Claire. Well, shall we move on to this week's Profit Cash Growth Extra then? So this week, Claire, you're going to talk to me about prepaid cards, aren't you?
Yes. It's something that we've rolled out to our team, and it's just eradicated expenses. And it's just the little things like we've run out of milk and somebody pops to the shop and now everybody's got these prepaid cards in their Apple Wallet.
Yeah.
We choose to use Apron because we use Apron for our payment runs, and Apron offer free prepaid cards that you can add to your Apple Wallet.
And if you spend £100 in the first so many days, you get £100 cash, or is that just...
No, they have got a promotional at the moment.
You're looking at me with a face of go, that's for accountants, haven't it?
No, I believe it is for everybody. That once you've activated an Apron prepaid card on your account,
get £100 for it.
Then if you spend £100, you get £100 cash back.
Oh, happy day.
Yeah. So they're really, really, literally, it's like so incredibly easy to set up. You go on the app, you put somebody's name in, and it sends them an email link, and they download the Apron app with their card, and then they can add it to their Apple Wallet and spend. And what we really like about it is that when somebody logs into the app, it reminds them if they haven't uploaded the receipt. So every time they use the card, the app is then sending them notifications, prompting them to make sure that they upload the receipt. So it's just a really simple, easy way of eradicating all of that paperwork and mess around expenses.
And the ecosystem just works really well.
Yeah,
from the payment through to the actual capture of the receipts and
card limits,
really
auto top-ups, all of that type of thing.
And there's plenty more out there other than that one if you don't particularly like that one. But do check it out, prepaid cards. Great. So thanks for joining us for another week's podcast. As always, because more and more and more people are listening to us all the time, please just share this with a friend or any business owner, anyone running a business, chewing the glass every single day, trying to get through those difficult days, who would just get benefit from listening to a short podcast once a week about little tidbits about how to grow their business. And if you feel like you might have outgrown your current accountant and you'd like to work with Claire and the team at Profit Cash Growth, nip over to the website profitcashgrowth.com. On there you can book a discovery call, have a chat with Claire and see how we can help you. And I'm off to listen to Be Here Now by Oasis. A bit of nostalgia there, and we'll see you again next week.